Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let me show you what I'm talking about here and build a neutral spread on the SPY. At this point in time, we have the spider at 129.99. So I'm looking to build a spread, and I'm going to do it as one unit. I'm going to buy a leg, picking up 10 contracts. It was a February 19th one, and I picked this up, I believe, on the exact same day that I shot the example from the other one. So it has 23 days to expiration. And I'm buying a call option that is basically in the money by 1 point. I'm buying the 129. There's my bid. There's my ask price. And simultaneously, I'm going to sell the same number of contracts, also a call option, also expiring in February, with a different strike. There's my vertical, 129 to 130. There's my bid. There's my ask. So here's my net on the bid side. Here's my net on the ask side. So I'm 59 by 63. I'm going to set it up somewhere in between. I'm going to try to squeeze the market makers and the traders for 61 cents as a debit. I set it up as a debit. Here's how the numbers work out. The break-even point is 129.61. Look at the current price, 129.99. My break-even point is below the current price. Automatically, you should think this is a relatively conservative trade. Shawn has built in a little bit of downward price flexibility. So I'll break even at 129.61. This may be a good opportunity for me to get into a market that's not exactly bullish, but it's not also exactly bearish. It's just quiet. And again, I'm okay with quiet markets. The maximum gain comes in if we can achieve a price of 130. What do you mean if we can achieve? We've already achieved it. We're sitting here at 129.99. So it's not just a matter of achieving it, it's a matter of holding the price of 130. And I'll make 39 cents if that happens. Maximum loss comes in at 129, and I'm going to lose 61 cents at that point in time. Now, there may be signs in the market that tell me, hey, get out before this thing loses much as far as its value, but it's a pretty tight spread. My return on risk is 63.9%. All I need this thing to do, if you think about it, what do you need your spread to do to make money? Most everybody says you need it to go up. Very different with a neutral spread like this. I don't care if it goes up. Well, I do care because it makes me happy. I don't care if it goes sideways. Well, I do because it makes me happy. But just don't go down. So I have to feel that at least the bullish trend is still intact. That's a neutral spread. Let's tweak it just a little bit. And instead of doing a 129, let's do a 130, 132 spread. So now I'm tweaking things out just a little bit here, and I'm looking at a 130 and a 132, and notice I did the exact same time, 23 days. I usually like to do a little bit more time than that. I really do like 4 to 6 weeks, or even 4 to 8 weeks. Same setup here, except that I'm buying the 130 and I'm selling the 132. And in this case, I'm going to set it up for a 93-cent debit. Well, the previous trade was a dollar-wide spread. So that means that really I could have made $1, but I paid, what, 61 cents for it? This is not a dollar-wide spread. This is a $2 wide spread. It's a $2 wide spread that I'm paying 93 cents for. So my break-even is basically my long leg plus what I'm paying for it, and that is an error on my part. Sorry about that, folks. I got a bad math in my head at that point in time. My break-even will be 130.93, not 130.91. It was wishful dreaming that I could get the spread down there at 91 cents. The maximum gain would come in at a price above 132. Above 132. Well, what about if it goes sideways, Shawn? Uh-oh, it won't be so good for you. I've got to get to 132. I've got to get to 130.93 before I break even at all. My maximum gain comes in at 132. If you think about the previous slide, the maximum gain came in at the current price at basically 130 or 1 penny higher. So this means that this trade is skewed to the bull side. It's got to move before I'm going to make my money. It's got to go to 132 before I hit my maximum gain. Anything over 132 is not additional money in my pocket. And my maximum loss here is going to come in at 130, where I lose 93 cents. So I have a return on risk of 115%. Yeah, I can make $1.07 on 93, or I can make $1,070 on $930. Of course, commissions will take some of that as well. The required move, I said this is bullish. How bullish is it? Well, the required move for 23 days is 0.07%. So there's not a huge requirement, less than 1%, for me to go ahead and profit from this. So the required move is not much. By the way, I've got my math wrong on that. Sorry about that. Again, I must have been not thinking about this slide very much. So I do need to move 0.7 or just under 1% for me to go ahead and make my money. So going back to probability, let me go back this slide here. Which one has the higher probability of success? Is it the one that doesn't have to move any at all, or is it the one that has to move 0.7% to make its money? And of course, the one that doesn't have to move at all. Which one's better? Well, this one has a better ROR, but you give up a little bit in the probability. And again, you get to completely decide how you want to set up these trades. Okay, so Y Shaw says, how do you manage the trade if the stock spikes up or gaps? Well, if it spikes up or gaps, happy day. There's nothing you need to do about it. Remember, you wanted it to go up. What you might be asking is the same thing that people say with a covered call. Well, I bought the stock at 20, it went to 23, and I wrote to 25, and now it's at 40 bucks. What do I do? My suggestion is that you take yourself out to dinner, because you've already hit pretty much, or you're well on your way to hitting your maximum profit. There is no, well, now I'm mad at myself for making some money, but I could have made more money if I didn't do this strategy. Know that going into it. I never suggest trying to repair a profitable trade. So if it does spike up, if it does gap up, celebrate that move. That's great. Now, the inverse question might be, well, what if it gaps down? How about this? This is what I do. When I look at a chart, I look for a history of not gapping. Because if it hasn't gapped in the past, I believe there's higher probability that it won't gap in the future. So I look for stocks that don't gap. I don't trade Cisco. Cisco likes to gap, and it likes to gap a lot. So I look for some of these stocks that you might consider extremely boring, and ETFs that are extremely boring, including the SPY. You know, not a lot of extreme gapping in the SPY. Let's talk about closing the trade, profit loss. Steve, I know I'm getting close to my time, so let me go ahead and wrap it up here.
You're fine, Shawn. Okay, good.
I'm okay, thank you. If it's profitable, then you're going to close the spread for a net credit. Well, keep in mind, you put on a net debit, you spent money. Okay, so you spent 65 cents. Now you're going to close it, maybe you're going to close it for $1. So that's how you get that 35-cent profit. You close it out for a net credit. Now, if you held it an at-the-money spread up through expiration, then you're going to be both exercised and auto-assigned. So your broker is going to both deliver shares to you and take shares from you as well. So keep in mind, you need to decide, is it better for me to close out the trade just prior to expiration, or is it better to go through and have the whole spread basically execute, exercise, and assign? Second point. If price breaks through your support level, and remember, this is a bullish trade, so if it breaks through support, look, the best thing you can do is salvage the remaining equity. I don't treat the kind of spreads that I just set up for you that were basically in the money or at the money. I don't typically do out the monies. You got to go into a salvage mode. If the trade starts to fall apart, there's still going to be some value left. It's like if you had a $45,000 car that got smashed on the freeway, and you didn't have insurance on it, you know, what would you do? Well, you could salvage some money. You could probably sell the seats. You could probably sell the tires. You could maybe sell some components from the engine. A little bit of money is better, I should say, a little bit of money that you could salvage from it is better than no money salvaging from it. So if it's clear to you that your support level has been violated and this trade is not going as anticipated, I say go into salvage mode. Don't go into wait and see mode. Salvage what you can so that you're not realizing these 65-cent losses to try to make 35 cents. So if you've got two-thirds of the time, let's say you're going to be successful of doing this, but one-third of the time you lose 65 cents, then basically it's, a dollar made, a dollar lost. But if you can see that the trend is breaking down and you can close out that trade and maybe salvage 35 cents, two-thirds of the time you're going to be right and you're going to collect your 35 cents, but one-third of the time you're going to be wrong and you're going to lose 35 cents. Hey, now you're coming out 35 cents ahead on 3 trades. So think about that as well. That's where we get into the probabilities. If it's speculative, meaning, I went ahead and stocks at 120 and I did a 125, 130 spread, and I went ahead and spent 15 cents on it. Well, let me make it a dollar-wide spread. I spent 15 cents debit to potentially make 85. That trade's so out the money anyway. I'll treat that as binary. It's all or none. I either make my money or I lose that 15 cents in that case. I don't do a lot of binary trading, but I do every so once in a while. If the underlying approaches expiration in between the long and short legs, this is the no man's land. So if it approaches expiration and it's in between your long leg, so in the example of the spread we did on the spider, that would be like 130.5 in a 130 and a 131 spread. Hey, I'm in the money on my long leg, but I'm out the money on my short leg. What do you want to do? Do you want to exercise your long call? See, you're going to get assigned on that, or you're going to get auto exercised on that long call, and you're going to get shares, but you don't have a buyer for your shares. No one's going to buy your shares at 131 if it closed at 130.5. But you're also not going to let your 130 in the money call option expire worthless. That thing's worth 50 cents. So as you approach expiration, either close out these trades and capture whatever premium is left, or just know this, come Monday, you're going to have shares of, in this case, the SPY in your account. Be sure you've got cash. One of the strategies is this. You know what? I'm still bullish on it. It just didn't go as high, as fast as I thought it would. So I'm going to take the shares. I'm going to get the exercise. I'm going to take the shares, and come Monday, I'm going to do a covered call. It's just another form of a spread is all it really is, or close it out. So just keep in mind that no man's land can often complicate people and kind of throw them off. Hey, what do? I don't have a buyer for my shares, and I'm going to get shares if I don't close this thing out. Well, then close it out. Or do you want the shares? Do you have the capital for the shares? Do you feel that there's risk in holding this in time as well? Okay, I think I am 3 minutes over, Steve. Sorry about that.
No, that's fine. Shawn, great job. Let's just try to take any questions that anyone has. Shawn, you did a great job explaining spreads and the benefits of spreads. I love spreads, traded spreads for, it's almost 3 decades now. So spreads are a great way to trade. Professionals trade spreads, and it's always up to every investor to decide what is right, what is wrong. And I saw a couple questions that alluded to how do you select the strike prices. So, Shawn, how do you do that?
Well, the way that I do it is, first of all, you have to ask yourself, how bullish am I on this? And if the answer is I'm really very bullish, then you can build an out-the-money one. You can build one that is basically going to be, let's say, in that 130. You could build a 132, 134, right? The idea here is that you have to feel comfortable that you're, of course, we're looking at an uptrend, that you're going to be, by time expiration hits of this spread, that you are going to be at your maximum profit point. If you look at the chart, and if you see that I'm asking the stock to do something that it's never done before. Let me give you an example. Stock's been doing 1 point a month for the past 6 months. If you build a spread that says, I'm going to build a spread in which it has to do 3 points in the next month, you're probably setting yourself up to fail. But if you say, I'm going to build a spread that will be at maximum profit in 1 month, and it has to move 1 point, boom, I think you found your answer. If you look at it and you see, wow, this thing has done 5 points in a month on this index, then I can build a spread that is 5 points out the money that will get me to maximum profit 5 points later. And if you have that kind of confidence, or you can just tone it down a little bit and say, this thing has been clipping off 5 points a month. I'm going to build a spread that's 3 points. All it has to do is go 3 points, and that will dictate basically how far out the money or how far in the money you have to go. So keep in mind, the more you go out the money, the greater your return on risk, but the lower your probability is that you're going to get there. If you go in the money, you could build a debit spread where you spend 90 cents to make 10 cents. And you may just say, high probability, but I'm not going to risk it. I'm not going to do that trade. So it'll feel right for you, but be sure that the amount that feels right is also based on the projected move of the index or the ETF or the stock that you're looking at in the chart. So it does go back to technical analysis.
Great point, Shawn. Next question is, what about how to manage a losing position, Shawn? So if the market it goes down to your break-even point, do you quickly exit? Do you hold on? Do you say, oh, thank God I have a spread on and I know my risk is limited? How do you view that?
Yeah, a good question. So I don't use a break-even point as an exit point. You can't, because people say, well, if you use the break-even as your exit point, you'll never lose money. No, but you'll be getting out all the time. So instead, you have to risk a little bit. So what I like to do is I like to look at as a support level in a bull call spread. I'll look at a support level in a very consistent ETF that doesn't experience a lot of historical gapping. That's really an issue with me for this kind of trading. And I will put a conditional order. So let's say on the S&P, if I went ahead and did that 130, 131, and I found that there was a significant historical support level at 124, and I'm going to keep the numbers 125. If it's at 125 and I build that 129, 130 spread, I really do have to have it come all the way down to this whatever support point I said, 124, 125, and I'll put a conditional order. And the conditional order basically says this: if the SPY trades at, I'll use 125, 124.98. I never put my conditional order right at support level. If it doesn't support it, it's going to come down. If it does support it, then my order should not trigger. I put it in at 124, 97, 98, 99, whatever number I feel I need for wiggle room. If this were to happen, then, and then the then is the, I need to buy a call to close, and that's me closing my short leg, and I need to sell a call to close. And what this is going to do, it hurts to say it, but it's going to salvage whatever this thing is worth left over. Let's say there's still 3 weeks left in the spread. These things are so out the money, all you're going to be capturing back is the remaining time. So you are going to lose a considerable percentage of it, but at least you didn't get completely wiped out in that case. So that's what I'm referring to. Now, if I can have it a little bit tighter, I love it when I've got a support level, let's say 128, and I can build a 129, 130 with the price right now maybe at 129.5. So I'm a little bit in the money, and I'm selling a little bit out the money, and I have a very nice tight support level so that if it comes down, the one that was out the money, that thing is practically worth nothing, and the one that was a little bit in the money hasn't suffered too much. It still has a decent amount of time value left, although the intrinsic value is gone there.
Good point. Shawn, how about Andrew's asking, what platform are you trading on?
I actually probably shouldn't discuss it. I use a number of different brokers and charts, and
okay.
I think
well,
really,
if you don't want it, that's fine, and it's okay to mention.
I'll tell you that entire presentation was built on Power E-Trade Pro, is what that was built on.
That's fine. That is fine.
Yeah.
Absolutely. So Andrew, there you go. And again, plenty of places to trade. E-Trade is one, but again, go out and search out your brokers based on functionality, price, customer service, and many other things. John has a question about credit spreads, and Shawn, I know you can't answer this one. You know, basically, his question is, how about credit spreads when you implement that strategy? So my question to you, Shawn, is, would you be willing to come back and talk about credit spreads at a future date?
I would. I love talking about credit spreads. It's actually my preference to do a credit spread for a number of reasons. They're relatively small, but I think they're important, especially as it relates to commission and it relates to how you manage your trade as well. So yeah, Steve, in the future, let's figure out times that work, and I'll work on a presentation for credit spreads that'll fit within an hour.
Awesome, and that's great, Shawn. And I want to thank you. because a couple of comments were saying that your presentation was the clearest they've ever heard on debit spreads, and they really understand it now. So you did a great job. Of course, we would have loved to see Rick today, but we hardly missed him. But I'm sure the next time we'll definitely miss him, as you did such a great job. Do you have any closing comments? I'm sure you do, about spread trading or anything else to do with options?
Absolutely. I want to say thank you for giving me the chance to go ahead and talk. I do love talking about strategy. That's my favorite thing. Rick does a great job of talking about technical analysis. So between the two of us, I think we kind of deliver a one-two punch when it comes to trading. Take a look at our website. It's promarketadvisors.com. There's also a calendar of where Rick and I will be at. We're going to be on an exchange tomorrow for a private event, or I should say we fly to Chicago tomorrow for a private event, and that'll be Thursday, Friday. If you're interested in anything that we offer, let us know. We love to teach, and we love to talk advanced strategies. It's so nice, Steve, to get out of first gear and start getting in second and third a little bit. So thanks for giving me a chance to go beyond calls today.
Shawn, great point. That's it's so important that the novice investor, as you said, starts with the calls and sometimes the puts, and then they get confused about volatility and time decay. Spreads really work, whether it's vertical spreads, but whether it's a credit or debit spread, it's up to the investor. But it is sort of the next level, and it's not that hard to get to. In fact, I think you did such a wonderful job in explaining it all. So thanks so much.
Thank you, everyone. Have a great week.
Take care, Shawn. That was Shawn Howell from Pro Market Advisors talking about beyond buying calls, full call spreads. And next time he'll come back and talk about credit spreads. If you're interested in what Shawn has and also what Rick has, please go to promarketadvisors.com and you can check out their services. I'd urge you to do that. Just want to remind everyone that next week at the IAC we have Andrew Hart, and he'll be talking about 10 steps to creating an effective trading system using ETFs. And Mike Tussar will be talking about ETF correlation, is it good or bad? And then Ryan Detrick will be talking about the importance of incorporating sentiment when trading ETFs. Please join us. Sign up for all of those presentations, and always try to attend. And if you can't attend, which I know you all have busy schedules, you can always go back to the archive, www.isc.com/archives, or iTunes or YouTube. I want to thank all of you, the attendees, and, of course, special thanks to Shawn Howell for making this a great presentation. I want to wish everyone a safe and happy trading day tomorrow, and please join us again next week, where we'll have another FX and another ETF presentation next Tuesday. Thanks again, everyone. On behalf of the IC, this is your host, Steve Meisinger, wishing you a great trading day tomorrow. Bye, all.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.